If you even assume moderate rates of inflation, for example, say 4%, your capital after about 15 years is actually halved in value.
The hardest question, I suppose, that most investors want to know.
It's important for us to ask the hard questions.
Hello and good day, everyone. Inflation is a hot topic at the moment, and the current levels of inflation that we're experiencing is a result of post-lockdown demand, which has been exacerbated by the recent Russian-Ukrainian war. Russia and Ukraine contribute about a third to global wheat production, and Russia is a strong exporter of energy. So what we have seen is a marked increase in prices of energy and food across the globe. Inflation is something that we must not underestimate because it certainly erodes our purchasing power. What that means is, if inflation is high, we need more money to actually purchase our usual goods and services. From an investment point of view, if you even assume moderate rates of inflation, for example, say 4%, your capital after about 15 years is actually halved in value. Asset classes actually behave very differently and respond differently to inflation. If you look at asset classes in general, equities have been a strong inflation hedge relative to other asset classes. Equities over the long term has delivered just above 7% above inflation. So you can see that by owning equities, we have strong purchasing power. There are points in time or periods in time where equities actually underperformed inflation, but these episodes are actually few. On the other hand, what we have observed is that cash over the long term has given you about 1% above inflation. So compare the relative return that you get from a cash investment versus that of equities, 1% versus the 7% above inflation. Although there are points in time in which cash has given you returns above inflation, these episodes are actually very few. So how does one actually hedge against inflation? So equities certainly has proven to be a long-term hedge. We also speak about gold. What we have observed is that in the 70s, gold has been a strong hedge against inflation. But from 1980 to the early 2000s, you've actually lost money if you had invested in gold. So you've lost money in real terms. In other words, you've reduced your purchasing power. During the 70s and just post-2010, we saw a strong bull markets in gold. But what's interesting is the dynamics of the gold market has changed. With the launch of the gold ETF in around 2004, we've seen that gold is now treated as a financial asset. Previously, gold was generally fixed and illiquid, and today it's actually a highly tradable commodity. That being said, gold certainly affords us some value in portfolio construction in the terms of portfolio insurance. So it depends on the price that you pay for the asset. It can certainly provide some levels of hedge against inflation. Putting all this together, what's important is that one needs to look through short-term volatility. And in doing so, one has to take a long-term view of the reinvestments to actually look through this noise and volatility that we experience frequently in financial markets. So what we at Old Mutual multi-managers do is build portfolios that provide some resilience against inflation. These are diversified portfolios that actually help build real wealth for our clients over the longer term. Thank you.